there's two types of taxes. There's the ordinary rate, which is it's your marginal tax bracket. This is whatever tax bracket you're in. This is also the highest tax. Now, the other one is the long-term capital gains, which this is going to be the lowest. So if we're investing something that has tax advantages, or even like stocks are long-term capital gains, or if you want a business or real estate, do not put anything with tax advantages in one of these government created plans, because we start to lose those tax advantages. Now, however, there's some investments that are going to be taxed at the highest rate. I mean, whether those are like a hard money lending, people investing in mortgage notes, that's going to be in the highest tax bracket, the marginal rate. So maybe once you have all your other ducks in a row, having one of these government controlled plans to house one of those investments, I think can make sense. Right?
Yeah.
Now, Cameron, let me ask you a question. What do you think is the reason why most people are hesitant to take the money out?
No, it's the boogeyman. It's the taxes, right? Everybody gets scared by the tax bill or the tax liability that's sitting in there. So that's what scares them.
Right? Because I'm going to argue here.
You're going to be wrong.
Well, let's see. Okay. And maybe if you're watching this on YouTube or let's make a comment. Tell me if I'm right or wrong. But I'm going to argue. You don't even know what I'm going to say, and you're already saying I'm wrong. But I could argue that you will end up paying more taxes if you leave it in.
No, I would agree with that.
Okay, so I am right. Perfect. Podcast over. Cameron agrees. Now,
so well, go ahead. So why would you say that?
Well, what I would say is money from an IRA. Now, let me take a moment here, because there is a Roth IRA, right? So we're mainly focusing on more of the traditional IRA or 401k, and the reason being, most people don't have Roths, and the downside of a Roth really kind of alludes to all the disadvantages that I just mentioned, but it's hard to get a lot of money in there.
Yeah.
Right. Like a Roth IRA has limits. So if you want to get 100 grand in there, man, it's going to take you many years. Right. And so I think most of the time we're having these conversations, it's more of the traditional IRAs or the government controlled plans that are pre-tax. So when we take them out is when we're going to pay tax. But back to why I would say you're into paying more taxes by leaving the money inside your IRA. And the reason being is your IRA is going to be taxed at the highest tax bracket, right? And what's interesting, most investments are actually taxed at the lowest tax bracket, the long-term capital gains. And in addition, with real estate or a business, has additional tax advantages, right? When you have your business, you're able, I like to say, put a business spin on an otherwise personal expense, meaning like you and me, Cameron, we have phones, we have cars, we go out to dinner, we do some traveling, we have internet, we may pay for some attorneys and all these other things. Now, a lot of these expenses we're going to have to pay anyways. However, because we have our own business, we can put that business spin on it and we have the ability to deduct it. However, if you're an employer maxing out your 401k, you're still incurring those expenses, but you're getting zero tax benefit from that. You want to see the entire episode? Click here. If you want to learn how investors use infinite banking to increase their returns and lower their taxes, click here. If you want to see if infinite banking is for you and you have some questions, hop on a discovery call with us and one of our coaches. The link for that will be in the description.